Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform that's built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to talk about important options data available in the ORATS APIs. Matt, do you want to share your screen and get us started by showing us some of the APIs?
Yeah, sure. And like you say, ORATS is built on these API on the data that we've been building. I was a market maker in the 90s and the 2000s and personally backed traders, and I would hire them to do these calculations, create these calculations, and eventually ORATS wound up using all these, and that's what ORATS is really built on. So I'm excited to get into these. But first, you want to talk about, so we have, this is going to be our new look, and under resources, we have an API console that kind of goes through all the different ways that you could access data. And there's a lot of different ways because there's a lot of different needs out there. And, we apologize in advance, but, the exchange data provisions really make us break out our data into certain categories in order to make it more, make it more less costly for people. So we've broken these data modules out. So maybe you could help us by going through, because you're an expert in this.
Yeah, thanks, Matt. Yeah, I'd be happy to. So basically, you can think about it in two different categories. So you can separate it historical and current data. So we have APIs for both historical data as well as current data. And then for the historical data, you can separate that into two categories as well, which we have end of day historical data and intraday historical data. Okay. So that's kind of the separation of the endpoints, and you can see all of them kind of broken up at the top there. The first tab is live data, second tab is live derived, third tab is delayed. When it comes to current data, we have a derived option, which is available to pros and enterprises who are looking to offer data in their platforms, but don't necessarily want to pay the exchange fees or the OPRA data fees for offering some data. So the derived option is great for pros and enterprises who want a sort of a replacement value or something that's good but not perfect in terms of the options prices. So that's sort of what the derived data is. But for retail traders, retail API users, and these are individual users, you really don't need to mine the derived data. So that's kind of like a quick overview of the different endpoints.
Yeah, and so I have, I'm a VBA guy, but I have an Excel sheet that might help to show the types of things that we have. So actually, VIX might be good to do. So you saw different things on there. So there's a strikes endpoint that gives you all of the options with the Greeks and the implied volatilities and the volume and all of that. So so here's VIX and we're showing open interest and bids and offers, and then implied volatilities, deltas, and Greeks at all different strikes. So this is the most detailed option, right? So this is one line per option, and then we summarize each month, for example, in what we call the implied monies, so the moneyness or the deltas. Yeah,
I want to answer one question we got from a client. I think it was just last week. They were asking, well, what's the difference between the APIs and the historical data, and why can't I see some of the summary information in the historical data? And that's because our historical data offering, and this is not the APIs. So the APIs will give you everything we have. The data that we offer historically that's delivered to S3 and to via FTP, that really only contains like the strikes information. So that does not
Right.
contain any summaries or the implied monies or anything like that. So that's an important distinction if you're ever between these two products and wondering what's the difference between the historical data here and the APIs, and that's the primary thing. So the APIs will give you a lot more data like the summaries and the implied monies and things like that.
Yeah, that's a good way to think about it. If you look on our site, we have it broken up by APIs and historical data. Historical data doesn't have all of the different moneyness and all that. So that's a good way to think about it, Tyler. Anyway, so back to what. So this is moneyness. This is only available on the APIs. So you'll notice that there are all the expirations. So we've gone from maybe 2,000 strikes down to 12 expirations that the VIX has. And interestingly, the stock price you'll see is changing. So what we call the stock price for the VIX is what we calculate the Greeks on. But for a cash settled index, they trade against what's called the futures price. So the futures price will vary as you go out in time. And for VIX, it's in contango right now, meaning that the longer dated strikes are higher than the close ones. And the spot is probably 19 or something, so it's below what the first month, the 11th, so 8 days out is. So that's the first thing that you'll notice for all stocks and ETFs. The stock price will just be the stock price that you'll see. But, obviously for SPX, it doesn't have a stock price fix, XSP and others. We calculate a implied futures that we then calculate all of the Greeks upon. So we have a risk-free rate, yield rate, there's no dividend, and residual rate solves for any leftover interest. And then we also slope that. So this is a little more complex than we really want to get into for today. We have a confidence factor, like how wide the markets are versus how many options there are. So, more confidence kind of in the outer months than the inner months. And then how wide the markets are. So it's very wide. This must be a new, like the 2nd of July must be a new one that they just added because it's really wide. But mostly it's only one vol point wide, but these are really wide. That's why there's no confidence almost in those.
So Matt, we do get a lot of people asking about the confidence because I think it strikes people as like, oh wow, what's that? How do you use the confidence? Is there like a minimum that you have in your mind? Like I have to have at least a 50% confidence to even trade this stock. Like how do you use that?
Yeah, thank you. It's a number that we've made. It's a proprietary calculation, and it's based on the number of strikes that have good bid volatilities and ask volatilities and how wide they are. So it's it's subjective, but it's also like you start to get a feel for it, and it is from 0 to 1. So I like to have one in the high 60s before I start trading it, just because otherwise they get it gets pretty wide. Like here's confidence around 45%, and it's 3 vol points wide. So that's a little wide for me, and so the confidence is a really important number to think about because when you're trading, you want to know, like these volatilities, these trading. There's a lot that you could use this confidence number for. We also have we'll get to next in the summaries is overall confidence. So an overall confidence for this stock might be maybe 60 something because it kind of averages that out and then brings it in. So we have a confidence for every expiration and a confidence overall for the for all the options in one stock.
Got it. Okay.
And same thing for market width too. So you might notice, like, you probably think market width is around 2 vol points wide, and that's in vol points. And then and then this is what the volatility is at the 100 delta, 95 all the way to 0 delta. So this gives you the skew. So it's a good look at skew. So you could tell, like, oh, the VIX is skewed, has a skew that's a smirk to the other side than most options have, because most options, and this is call delta. So these are lower strikes and higher strikes. Usually in stocks and ETFs, you'll see higher vols at the 95 than at the 5 or delta. So that's another interesting thing that we show. And then, well, the spot price is well below. That's 18.31. And then we have a slope. So the slope, again, for most stocks is positive. So it's negative for VIX, because, you know, like I said, it's opposite than most of the.
So the slope, just to clarify this, so we're measuring the implied volatility skew, which is basically all those vol 45, vol 40, vol 35. That draws the skew.
Right.
And then the slope is the measurement of the skew if you were to draw a tangent line at the 50 delta point in the ideal skew.
And it basically it answers the question, for every 10 deltas, what percentage difference is the lower strike than the upper strike? So in this, in this percent, it would be 3% less. So, and you could, you know, so you kind of see that potentially here. So I don't know, there's, you know, 55 to 45, you know, it's about, like I said, it's about, you know, 87, you know, whatever that percentage is difference is the kind of, is the skew, is the slope. And the derivative is how much the slope changes as you go. So it gets steeper and steeper and shallower and shallower. So that's, you
could essentially draw the skew just with those two metrics.
Yeah, and that's what it's for. And it's also a quick and dirty way to see what the skew is, you know, relative to history, and is it getting steeper, and all that. So actually we could. So now we're going to the options chain because it gives a good visual. So you can see that the skew in VIX is, you know, going up like this. In Apple, and then so anyway, there's a slope. So we bring these in. So we show, and here's the confidence that we're talking about. So we just bring these in from the monies file. But like for Apple, so you can see how it's completely different, because, you know, really when Apple and the market go down, it goes down faster than it goes up. And but when Apple goes down, volatility comes up. VIX is a measure of volatility, so that's why the upper strikes are skewed up in VIX versus Apple. Hopefully that makes sense. So we draw this orange line through all these dots. So you can tell some of the dots are off the skew, and that is because of usually market imbalances. People are buying or selling a certain option. So, you know, so like I said, so like the slope. So here's that slope in Apple. It's the mirror image. It's 3% positive. You know, again, if you drew this line and you went every 10 deltas, the volatility would be 3% higher than the high strike on the low strike.
Yeah, it's interesting how the summaries information is presented here. I mean, I think if you're a retail trader, having access to this information in an API that's easy to use, it's a REST-based API, and you're getting these summaries. It's a great way to scan for trades and to just display the information for your own use.
Yeah, and here's a good point. Like here's a confidence. Like you could tell there are fewer dots on this June 27th weekly, right? So it's just slightly, still 87% confidence. So still high confidence, but you can see 100% confidence here because there's so many dots that we could draw that line a lot better. So there's an example of the confidence, Tyler.
Yeah, that's pretty cool how you can see it on there.
Yeah. So yeah, let's go back to what we were talking about from in the resources. And so we've gone through strikes, we've gone through monies. The next thing is the summaries. So the summary is kind of my favorite part. So if in data history, so I pulled up all of Apple's kind of history just in one click. And so what we show in summaries, trade date, stock price, the dividend information, the implied borrow rate. So what the implied borrow rate is basically it's the residual rate once you put in dividends and interest. Is there any kind of leftover amount? There's that confidence. So we do the average confidence. So right now it's like 95% in Apple, and then we do X earnings 10-day implied volatility. So it's 31. And if there's no earnings in Apple, the actual 10-day will be the same, which is 31.0901. So, but I think Apple's, I don't know, probably 60 days out. Let's see. Yeah, there's one. So the X earnings, we have a way to take out the earnings effect and draw a skew that is rational, and that takes out earnings implied volatility. So you can see it's 29 in the raw number at 60 days out, but the 60 days out is 27.5 for the X earnings. So you could tell there's 1.5 vol points of earnings in that one. And then, you could see that IV90 is also 29, but it's 20 basic 7 here. So those are very interesting. So it's more stable. The X earnings is more stable. So if you're looking at just, what's the implied volatility of Apple over its lifetime, you probably want to use X earnings, because otherwise what you'll see, and then, we have a good graphic of that in our trade builder. It shows
I was going to say the outlook you can see the X earnings, you can toggle the X earnings and the non.
Oh yeah. Yeah. Yeah, that's true. But I'll just show it first in here. Yeah. So you can kind of see like these vertical lines are when earnings are. So the volatility just goes up and up and up and then down, up and up and up, then down, up and up and up, then down. Some weird stuff went on, but basically up and then down. And then what Tyler was talking about in the Outlook tab, one of the things that you could do is toggle between earnings and X earnings. And the Outlook tab does take a little while to calculate, because there's a lot of calculations going on, but it's worth it once it opens.
It's doing some predictive analysis based on the back tests of how indicators can predict implied volatility and stock price. So that's essentially what it's doing.
Right, and I'm on my laptop, so it's probably going to take a little bit longer, because it does do some calculations locally. But yeah. Anyway, let's just take our word for it that you could toggle in between. Maybe we could come back to that. So that's the difference between the X earnings and earnings, and then we have this constant maturity at the 50 delta. So that's another thing that people ask. These are all at the 50 delta calculations. So if you remember back to the monies, it's there's a 50 delta and there's all the other ones. So we draw that through where the orange line that we draw crosses. So we have that very good volatility. And here's that market width that we talked about a little bit too. So we do that interpolated at the 30-day and also at the 2-year interpolate. So this is how wide or actually very tight the markets are. It's only a third of a vol point wide in Apple. Wow. Here's that derivative and slope. So the slope is about 3.1, and it's cool to be able to see how it's changed over time. So there's that. And then we have a different calculation for, some people ask us, which is between RVol 30 and IV 30-day. RVol 30 is one of the parameters that we use to calculate the entire volatility surface, we try to do it with a 30-day, a 2-year slope, derivative, and earnings. And just with those, we try to summarize the entire volatility skew. So that's how those are different. And so, and sometimes those are, we do a ratio of those, and sometimes that's, an interesting number to look at. So that's what that is. A RIP value is an old calculation that we've came up with on the floor for what's the, kind of value when you should start taking deltas out of your position. So it's more of a positions management type of a calculation. Again, it's a longer conversation, but that's what that is. The risk-free rates. There's contango. Interestingly, contango is slightly negative right now, meaning the volatility is basically flat. It's mostly contango is positive, which means the front months are lower than the back months. Don't worry about the air. So, and then we start talking about what's the 5 delta. So what's that skew? And we measure it at 10 days, 20 days, 30 days, and then we measure the X earnings 5-day. So you really get into the skew numbers here and see how those change. 25 delta, 75 delta. Of course, you have our 50 delta already, but these give you some constant maturity X earnings and not X earnings. So it's a lot of data, but again, we feel it's some important data for people that are looking at skew. And then, some people look at skew in various ways, and other people look at term structure in various ways. And one of the ways to think about term structure is a forward volatility calculation. And what a forward volatility calculation does is it says, well, the 30-day might be a 30 vol, and the 20-day might be a 31 vol. So between the 30 and 31, it has to be higher, because it has a certain number of days that will run at a 30 vol, and then it goes up to 31. So it has to bump up, so it would be 32 or something like that between those two. So there are forward volatility calculations that you could look up on our site or a university to get more information on that. But we have a lot of those, and we actually calculate it in 2 different ways. An F forward is called a flat forward, and that's where you solve for the price of the calendar trade priced at 100, in this case, 180 days and 90 days. So it usually comes up with a very similar implied volatility for that flat forward and the regular calculated forward. I kind of think of it as a calendar forward and just like a historical volatility almost calculation forward. But those differences are important, and then we call that FB. Those are this divided by that, F flat by flat, and so we have percentages, and we find that those percentages have some interesting predictive values to them. So, we're going to be coming out with an optimization of backtests, and we'll be able to use these types of optimizations in those against those backtests. And one of the ones I like to use is the FB, because it divides the flat forward by the regular forward, and you can see when there's duress and when those are very different, duress in the market, and that's a good way to identify that. And then one of my favorite numbers is the implied earnings effect. We looked at X earnings, and I mentioned that we have a way to take out the volatility. Well, once we take it out, we know what that percent move implied is, and that's what we show here. So it's about 5% implied move for Apple. And then you could jump over to the one of our favorite here's the outlook, Tyler. So you wanted to look at the term structure with earnings and X earnings. So it really, it smooths it out if you have X earnings. You could tell that that's in backwardation or negative contango right now. So yeah, this is one of my favorite pages, but it's a little bit, it behooves people to, I think, learn how to look at these pages, because it's a good way to look at what volatility is like. Here's Apple's implied volatilities versus the XLK. It's been going up and up. Not only is it in backwardation, but the implied volatility is relatively high in Apple right now. You can see that pretty well, I think, in the Outlook page.
Yeah.
So where was I, Tyler? I was going to look at the earnings page. So in Apple.
Yeah. This is another visualization of the,
yeah. It's very popular, and you can see that, it's 4.9 right now for earnings, but look at it's 4.1, 3.9 before. So it's a lot higher than normal. And so we're seeing, people with a lot of uncertainty in Apple right now. There's a lot of uncertainty in the market. So, that's an interesting thing to look at.
Yeah, and I want to mention all this summary data, all these things that you've been going over. They're available in the live API with around 10 seconds of delay, so it's very close to real time. Like, you calculate these things very fast. Yeah,
it's a lot of calculation. So, like I said, today we've gone over what our tool. This is our tools here, and they marry up really well. So this is a good visualization of all the options data. But we've gone through a lot of the important bits of data. Some people like to get the data with the APIs, and some people like to come in. So we like to into our tools. So we like to offer it in both ways. So these are like I said, very important calculations. If you're really looking at volatility and when to trade certain strategies, this is a very good place to start. And you could also backtest under certain of these data points, if it's high or low, which backtests do better. So there's a lot that you could do, and ORATS tries to bring it to you so you could trade more profitably. Tyler.
Yeah, thanks, Matt. That was a great explanation of so many different indicators and how to use them all in 30 minutes. So I think you did a great job.
Thank you.
Yeah, if you guys have any questions, let us know live on the show. We get a lot of support, and we like to answer questions as they come up. You can ask us about how to use the dashboard. You can ask us about certain indicators in the APIs. Pretty much anything on the show, we're happy to answer them. We want this live show to be more of a place for people to come and tell us things that they want to do and learn, and ask us questions, and have it be more interactive. So we're going to try to push that a little bit more. You can still continue to send us questions at our support@orats.com email, or ask them in the community tab. So the community is growing. We have like 60 or 70 members now, I think, in the community. So we're getting people answering each other's questions, which is great. That's another great place to get your questions answered. All right, Matt, unless there's anything else, I think that wraps it up for today.
No, I'm good. Thanks, Tyler.
All right, thanks, Matt, and thank you, Trader, for hosting us. We'll see you guys again next week.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.